My name is Forex Mike, popularly known as Ninja FX in Forex world globally. I am the Chief Executive Officer of Integrated FX Solutions, known as IFX Solution. I want to use this opportunity to congratulate you for purchasing this self-tutored video. I will say with confidence that you are one step closer to trading the currency market with consistent profit. The Holy Scripture says, "My people perish because they lack knowledge." This is also applicable to the currency market, as many traders struggle or fail because they don't have the right education. This video will teach you exactly how to trade the currency market, and if you can apply the knowledge taught thoroughly, I'm very certain there will be a positive transformation in your trading account. Lesson 1: Introduction to Forex Market. Introduction to Forex market. What is Forex? The foreign exchange market, or Forex, also known as FX, currency market or spot, is a worldwide decentralized over-the-counter financial market for trading of currency. It is a decentralized market, a network of banks known as interbanks, and then currencies are traded in the foreign exchange market. The primary purpose of the foreign exchange market is to assist international trade and investment by allowing business to convert one currency to another currency. The foreign exchange market was established to facilitate trade exchange among countries. Trade exchange among countries, buying across the border, buying across the international border. Now, take for instance, if you want to buy a Toyota car from Japan, or buy a Toyota car from Japan, what you have to do is to exchange your local currency to Japanese yen. Now, the process of exchange, it's involved in the foreign exchange market. Now, foreign exchange market is very unique compared to other markets. It has high liquidity, so much money to trade with. At every point in time, there is always a buy and sell. There is always a seller and a buyer. It's a continuous operation in the sense that it's a market that never sleeps. The operation is continuous 24/7. There's use of leverage. It's a market that is highly leveraged so that the retail traders can participate in the most liquid market in the world. Also, it has a low transaction cost. Now, we're moving to another section in the introduction to foreign exchange market, and this I call market participants. Who are the people involved in FX? You might want to say, who are the people involved in trading FX? Now, I have the following as market participants. We have the banks. You can call them interbanks. the network of banks. We have the commercial companies, we have the central banks, the hedge funds, they are known as speculators, the retail FX brokers. Unlike a stock market, the foreign exchange market is divided into level of assets. At the top is the interbank market, which is made up of the largest commercial banks and securities dealers. The top tier interbank market accounts for over 53% of all transactions. After that, there are usually smaller banks, followed by large multinational corporations which need to pay employees in different countries, large hedge funds, and even some of the retail FX market makers. So we have the banks, the commercial companies, the central banks, the hedge funds, and the retail FX brokers as market participants. Now, the interbanks. The interbanks, known as the large banks. The interbanks market caters for both the majority of the commercial turnover and large amounts of speculative trading every day. Now, what is the role of the interbanks in the FX market? Now, let's look at this. For instance, if ExxonMobil wants to pay its staff across the globe, so they will route the instruction of payment through these interbanks. These interbanks are known as liquidity providers. So example is Citibank, Deutsche Bank, Swiss Bank, Goldman, and such. The commercial companies. An important part of this market comes from the financial activities of companies seeking foreign exchange to pay for goods or services. Now, there's something I want you to note here, that the majority of the transaction in FX is being carried out by the commercial companies, not in volume but in the total amount. Now, it's known, according to Wikipedia, that 3.9 trillion US dollars is being traded every day on the forex market. The commercial companies trades more than half of this on a daily basis. They are always doing this for commercial gains. Example, we have the Microsoft, we have the ExxonMobil, Toyota, and Coca-Cola. They are spread across the globe, and they are always buying. There's always a buying and selling across the globe on these commercial companies. The central banks. The national central banks play an important role in the foreign exchange market. So, another participant aside from the commercial company is the central banks. They try to control the money supply, inflation, and interest rate. Okay, the job of the central bank is to regulate the currency, and they control the inflation. So they are also part of the FX participants. Examples: Bank of Japan, Bank of England, Swiss National Bank, Central Bank of Nigeria. Now, the hedge funds. The hedge fund is also part of the FX participants. About 70 to 90% of the foreign exchange transactions are speculative. In other words, these guys are trading for speculative reasons. Okay, they are using their technical and fundamental analysis tools to predict price movement and profit from this price movement. In other words, the person or institution that bought or sold the currency has no plan to actually take delivery of the currency in the end. Rather, they were solely speculating on the movement of that particular currency for profit. Example is JP Morgan Chase, Soros Fund Management, headed by George Soros, Paulson and Co., Bridgewater Associates. We also have the retail FX broker as participants. Retail traders, that's the individual traders, constitute a growing segment of this market, both in size and importance. Currently, they participate indirectly through brokers or bank. Retail brokers, while largely controlled and regulated in the US by NFA. So these guys, brokers, act as an intermediate between the traders and the market. So they act as a middleman between the individual trader and the FX market. So we have two types. We have the brokers and the dealers. The dealers are known as market maker and the brokers are known as agents. Now, the brokers. Brokers serve as an agent of the customer in the broader FX market by seeking the best price in the market for a retail order and dealing on behalf of the retail customer. They charge a commission or markup in addition to the price obtained in the market. So these guys, the agents, they go to the market to seek the best price for their clients and offer the clients the best price from the FX market, and they are paid for doing that. They cater for big players among the retail traders, and the minimum trading capital required to start with them, it's $10,000 US. But because competition is a beautiful thing, we have a lot of brokers now. So due to competition, startup capital has been reduced to about $3,000 US. Example is Dukas Copy, MB Trading. So brokers, they are agents. They seek for the best price in the market and offer their clients, and their clients pay a low transaction cost for the job well done. The dealers, they are known as market makers. By contrast, typically act as principal in the transaction versus the retail customer and quote a price they are willing to deal at. So what they do is they go to the market, seek the best price and quote a price they are willing to offer their clients. So they get the best price and there's also a markup. So they give their clients what they are willing to give to them, and aside from having a markup, the clients still have to pay a certain amount of money in commission. So they cater for most of the retail traders and offer as low as $100 as trading capital. In fact, Marketivia it's offered $5, while FXCM micro accounts offer as low as $40. So they are very smart guys in this, because their startup capital is very low thereby enticing small retail traders to come to their platform. So example is Boston Merchant Finance, FX Pro, FXCM, Forex Capital Market, Forex.com, and Alpari. Lastly, on the participants, we have the money transfer. Okay, money transfer companies stroke remittance companies perform high volume, low value transfer, generally by economic migrants back to their home country. So for money transfer, we have a good example is a Western Union. If a trader or somebody in the country A wants to transfer money to B, his local country, maybe the person is working as a migrant in the country A and want to transfer some money to his family, so the transfer is done via this money transfer company, Western Union and MoneyGram. These are the most popular ones. The largest and the best known provider is the Western Union. They are also participants in the FX market. Now, basic requirements needed to trade Forex. Basic requirements needed to trade Forex. What are the basic things needed to trade Forex? Until the late 1994, only institutional investors could play this game. The initial requirement needed to trade with is about 50 million US dollars. That's quite a large sum. 15 million US dollars. However, with the advent of internet, this has brought about to rise in participants in the FX market. However, because of the rise of the internet, online forex trading firms are now able to offer trading accounts to retail traders with small accounts. The internet has opened up a lot of opportunity for people. Without the internet, most people won't have the opportunity to trade the FX market. So, to the father of the internet, we'll say thank you. So the basic requirements are computer. You need to have a PC. Okay, then a high-speed internet. Then the final thing needed is a broker platform. A broker platform like Meta 4. We now have Meta 5. So if you want to trade FX, all you got to need is a computer in your home, a high-speed internet. Once your computer is connected online, then you have a broker platform. That's all you needed to trade the FX market. Now we are moving on to the next section. That's what I call comparative studies between Forex and stocks. Comparative studies between Forex and stocks. The reason why we are trying to compare FX and stocks is because we know that many people are quite familiar with stocks. So it will be a very good thing to try to give a good explanation to FX by studying the stocks that many people are very familiar with. Now, comparing FX and stock in terms of investment type. What type of investment is FX compared to stocks? Forex is primarily a short-term investment. Most traders buy and sell within a 24-hour period. Sometimes it takes even only a few minutes to close a Forex transaction. This is unlike stocks, where investors can hold on to their stocks for the long haul and wait for dividends to be paid out. In FX, most traders close within 24 hours. Though we have some position traders in FX that their positions are normally closed, or their positions could stay as long as 1 week, 2 weeks, 1 month. But in stocks, this is also a short-term trade compared to stocks, because in stocks you can hold on to your investment for as long as 5 years. You can hold on to your investment for like 6 months. So stocks is a long-term type of investment compared to FX. Now, transaction fee. In FX, the broker earns their money by setting the spread. The spread is what we call the transaction fee. Okay, in FX, the transaction fee is very small compared to the trade cost. But in stocks, a broker earns as high as 2% of the trade cost as commission. What the broker earns in FX is very insignificant compared to the trade cost. So in other words, the transaction fee in FX is very much lower compared to that of stock brokers. Now, liquidity. Within the forex market, about $3.9 trillion is being transacted daily. The stock market only handles a fraction of the amount. In American Stock Exchange, the total daily transaction is only worth about 100 billion US dollars. The huge trading volume in Forex only means that it is one of the most liquid markets in the world. In fact, it is the most liquid market in the world. There is always a buyer and a seller for any given currency at every point in time. The stock market does not have this kind of trades precisely. Now, in the FX, 3.9 trillion, that's the largest financial market in the world, larger than the foreign reserve of China, which is valued at about 1.5 trillion US dollars. Okay, so there's so much liquid in FX compared to stock. The market is larger compared to stocks. Now, trading time. We are going to compare the trading time. The forex market is not centralized, and forex trading market can be found worldwide. Given the different time zone, it is possible to trade 24 hours a day, 5 days a week. Now, ideally, the trading time is 24/7. That's every time. The market never sleeps. But the market is closed to retail trader at about 10 p.m. Nigerian time, 5 p.m. Eastern time, 4 p.m. GMT on Fridays. Okay, and is open on Sunday at 5 p.m. Eastern time. Stock exchanges, by contrast, have more limited trading hour. Although it is possible to trade stocks worldwide, each stock exchange is independent from the other and typically only operates 7 hours a day. So you can see has limited operating hour, 7 hours. But FX is 24/7, 24 hours, 7 days a week. Also, if a stock is traded on a particular exchange, it is not possible for it to be traded elsewhere. Market manipulation. Forex is a more predictable instrument than stocks. Forex prices have historically followed well-established trends. A forex trader needs only to draw up a trading strategy based on either fundamental or technical analysis to maximize profit. Now, in FX, we're looking at 3.2 trillion US dollars being traded daily. This is more than the richest country in the world, which is China, who has the largest forex reserve. Okay, now it's very difficult for a single entity or an institution to manipulate compared to stock, where there is so much inside trading, and of course it's known that many executives manipulate stocks, okay, because they have access to inside info that many investors don't have access to. So manipulation in FX is limited or is none compared to stocks that is heavily manipulated. Startup capital. This advantage of relative stability in forex is supplemented by the fact that it doesn't take so much money to get started in forex. There are forex mini accounts available as low as $25, and you buy and sell at 100 times your actual deposit. So the startup capital for forex is very small compared to stock, and that's a very good advantage. That means anybody can get involved, can participate in the FX market. Now we are moving to the final segment of the introduction to FX markets. We are moving on to definition of terms. There are some terms that needed to be explained. Okay, so now we'll be moving on to definition of terms as related to currency. Now looking at my chart, I have the Euro USD in a diagram. Okay, Euro USD, that's the price. Now Euro USD, it's a currency pair traded in the FX market. There are a lot. Euro USD is a good example of a currency pair traded. So let's start with base currency. Base currency. This is the first currency in the currency pair. In the currency pair Euro USD, the base currency is the euro. Now, euro is the European Union currency. USD is dollar as spent by the Americans. Now the counter currency. The second currency in the currency pair is known as the counter currency. So the symbol USD is the counter currency. Now pip. What is a pip? A pip is percentage in point. We refer this to the last digit of the currency price. Then spread. Spread is refers to as the difference between the sell and the buy price of a currency. The spread is the commission paid to the broker on every transaction. Now looking at the diagram I have on the screen, Euro USD, we have the sell price at 1.2635 and the buy price at 1.2638. Now the difference between the buy and the sell price is 3 pips. Okay, so let's move on to the last aspect, that's definition of terms as related to trading account. Lots. What is lot size? Lot. In Forex, the minimum amount of currency you have to buy is known as lot. That means that units of currency are grouped and traded in lots. If you want, it's like buying buying egg in the market. You buy in crates. Okay, and in some countries, if you want to buy beer, you buy in cartons. Okay, if you want to buy sweets, you buy in packet. So there's always a standard unit in every aspect of trading. So in FX, we use lot size. At a retail level, lots are divided into several categories. The so-called full size or standard lot. We also have a mini lot and as well as the micro lot. Now, leverage. According to Robert Kiyosaki, leverage is when we use less to achieve much. That is, using less to achieve much. So this also can be defined or explained in FX as a form of credit or loan which allows us to trade with money from the broker. Now, in this market, there is a standard trading amount. For a standard account is 100,000 K. That's 100,000 USD. Now, for a mini account is 10,000 K, and that's 10,000 USD. And it's obvious that not many people can afford 10,000 USD to trade with. So there comes leverage. Now, if a broker is offering a 1 to 100 leverage, so that means for every $1, the trader has a control of $100. So that's how leverage come about in FX. Now, margin. In the forex market, the term margin is the most often referring to the amount of money required to open a leveraged position or a contract in the market. Margin call. A margin call is reached if a customer's account equity falls below the required margin. So in lesson 1, we've treated what FX is in general. We've defined FX. We've named the participants in FX. So I want you to enjoy the video as we continue with our lesson. Thank you.